What's up, everybody? Welcome back to the StockTrades.ca YouTube channel. My name is Dan Kent, one of the co-founders of StockTrades.ca. Over the last month or so, I've been going extensively into Canadian ETFs, and now I'm going to turn back and focus on some excellent Canadian stocks. Some of the best stocks in the country, in my opinion. So with that being said, let's go over 3 opportunities that we see right now in the markets. Let's get started. Now, there's one thing that these 3 stocks that I'm going to talk about have in common, and that is that we identified them over at Stock Trades Premium to premium members at significantly cheaper prices. I mean, one of the stocks on this list is now approaching a 900% return since the end of 2018. So if you do want to join Stock Trades Premium, you can get started for free in the description below. You'll get 3 of our 10 foundational picks, and if you do want to upgrade to the market beat platform that we do offer, you will get a huge discount when you do sign up for free. And just speaking on the markets overall, I know it's been rocky. I mean, last week we saw the TSX dip around 2.5%, and a lot of people are panicking, to say the least. I mean, we aren't even a quarter of the way to this being an actual clear-cut correction, which is about 10%. I mean, these markets really have not dipped that much, especially the TSX. Back in March of 2020, we saw indexes falling, 6-7% every day. Last week, the TSX, I think, lost around 2.5%. Those saying this is a market crash or even a market correction are just either trying to scare you or really don't know what they're talking about. This is a short-term blip on the radar. Could it continue? Absolutely. You have to keep a very close eye on the bond rates right now. If they tend to rise again, you can see the markets dip even further as we move forward. And if they start to fall, we could see the markets recover a bit as well. The bond rates are essentially a clear-cut sign on the overall future outlook for the economy, and especially when interest rates rise, this is generally poor for growth companies because of the higher capital costs that rising interest rates have. And this also affects companies with high debt loads. This is why you see something like utility companies and telecom companies are suffering right now. That is because with high debt loads, higher interest rates are generally not good for them. And with high growth companies, higher capital costs due to financing cause their bottom line to shrink. This is, a very, very, very quick generic overview as to why rising interest rates and essentially high bond yields are generally poor for stocks, and why large institutional investors with higher bond rates may choose to make the switch to fixed income. When these huge institutional investors make the switch, it tends to cause the markets to be extremely rocky, and that is why we are seeing what we are seeing right now. But anyways, back to these top 3 stocks, and the first one we're going to go over is Shopify. So we highlighted Shopify to premium members back in late 2018 in the $172 range, and the stock is now trading at a 858% premium to that price. But I still do feel, and we at Stock Trades do still feel, that although the huge money is likely made in Shopify, there is still plenty of upside in this stock, and it has been one of the best performing Canadian stocks in history. I mean, before we get into a little bit of what Shopify does, if we look to its chart, since its 2015 IPO, if you were to have invested $10,000 at that time, you would already be sitting on gains of $527,000. This is a massive, massive opportunity that a lot of Canadians got in on the ground floor on. So what exactly does Shopify do? Well, they offer an e-commerce platform primarily towards small and medium-sized businesses globally. They operate in two primary segments, which would be their subscription solutions and merchant solutions. So subscription solutions essentially allows merchants to conduct business through Shopify's tools, while merchant solutions helps businesses become more efficient via Shopify payments, Shopify shipping, and Shopify capital. Over the last 5 years, Shopify has achieved annual revenue growth that exceeds 65%. Now, this type of revenue growth from a company the size of Shopify is extremely rare. Now, the company definitely is seeing slowing revenue growth over the last 3 years, and right now it sits at around 52% annually, but this is still a company that is growing at a crazy rapid pace. And if we look to COVID-19, the havoc that it wreaked on the economy in 2020, we see that Shopify essentially almost doubled its revenue. So it is increasing its pace of growth, despite it being one of Canada's largest companies. And if we look to valuations for Shopify, I mean, I have heard time and time again that this is an overvalued company and is due for a huge correction. I mean, I heard it at $150, $300, $400, $800, $1,200, $1,500, $1,800. It is non-stop, and a lot of people just refuse to believe in the overall trajectory of this company. We don't feel Shopify's growth is going to slow, and will its stock price return, even the returns we've seen from 2018 till 2020? Not likely, but there is still upside in the stock today. If we look at the company's income statement, we can see that it is consistently growing revenue. I mean, we see in 2015, it had operating revenue of only $262 million. Fast forward to 2020 to close out 2020, and you're seeing $3.926 billion. And if we compare this to 2019, you're seeing that revenues have, yes, essentially doubled to close out 2020. Now, will we expect slower growth in 2021? Absolutely. This $4 billion, a lot of it was fueled by people heading from brick and mortar businesses that were shut down to online Shopify merchant stores. But the number one thing that bears say about this company is that in 2021, these merchants will simply open back up their stores, they'll cancel their Shopify subscriptions, and they'll head back to selling brick and mortar only. And this just isn't the case. We've seen that even though stores are opening back up, these merchants are deciding to stick with Shopify because they are making money on the platform. Now, if we look to revenue and earnings estimates from Shopify, we can see that the trajectory is exceptionally high for this company. We can see in 2019 and 2020, the company beat revenue estimates. The orange is actual posted revenue, while the blue is estimated. In 2023, they expect the company to have revenues of $10.48 billion, while in 2020, they posted revenue of that $3.9 billion. So this is a 250% increase from revenues today. And if we look to valuation, Shopify is trading at 50 times sales. This is arguably the most expensive Shopify has been. But the overall thing about Shopify is investors are willing to pay this premium right now because of the company's reliability when it comes to growth. And there is arguably some valuation priced into this stock for continued growth because of the exposure it's gotten due to COVID-19. A lot of bears also are factoring in the idea that Amazon is going to enter the space. They've already entered the space and they generally failed at doing so. I have no fears that Amazon will take market share from Shopify, and I expect them to continue to dominate in the tech space moving forward. But the next stock we're going to speak on is a trucking company, trucking and logistics company. We touted this company as a value play at premium for a long time, and those who waited patiently seen some huge gains, including myself, and that is TFI International. They trade under the ticker TFII.TO on the TSX. Now, we highlighted TFII to members in mid-2019, and we essentially stated that this was a trucking and logistics play that was not being recognized by the overall market at all. And its price at this time was essentially in the low $40 range, and through the course of 2019 it traded relatively flat. I mean, if we look to its 5-year chart, we can see that pretty much from the course of mid 2018 all the way up until the COVID-19 crash, the company didn't really move that much. And during the crash, it essentially collapsed. I mean, we see the company now reset back to essentially mid 2016 gains when the market crashed. And at this point, we relayed it again to members, and I myself loaded up on a ton of shares of TFI. And essentially, when this stock recovered, it made up almost 20% of my overall portfolio. That is how much this stock recovered post-COVID. I have since rebalanced. I don't own that much of TFI anymore. It's around 7%. But the market had consistently overlooked this company, and now we are clearly seeing that it is one of the best trucking and logistics companies in North America. So what exactly does TFII do, and why have they recovered so drastically since the March crash of 2020? So TFI is a trucking and logistics company. They operate primarily in 4 segments. That's package and courier, less than truckload, truckload, and logistics. And they have around 17,500 employees, and they have over 400 terminals across North America. So they do have operations in the United States, but the bulk of its revenue does come from Canada. So during COVID-19, during 2020, the company reported quarterly results in June, and this would have been for the 3 months prior, and that was when COVID-19, essentially the shutdowns were rampant. We didn't know much about the virus. The economy essentially was in complete lockdown. This is a company that saw revenue dip by only 8.6% over that time period, and more importantly, it saw free cash flow actually go up. So what this company was able to do is essentially buy up assets from struggling trucking companies because of COVID-19, and as a result, they added to their fleet, they added to their overall company significantly for essentially pennies on the dollar. TFI took advantage of the situation and bought assets at discount rates, highlighting the ability of its management. And more importantly, and the #1 acquisition that has saw its stock price soar recently, is that it acquired a division of UPS, its UPS Freight, which is less than truckload and dedicated truckload divisions of UPS, which, if you haven't heard of them, they're one of the biggest shipping companies in the world. And this acquisition is essentially going to drive long-term revenue and earnings growth, and it is expected to be essentially immediately accretive to diluted earnings per share in 2021. So TFI is going to realize significant upside from this deal almost immediately, and the market reacted quite drastically, sending its share price from the $65 range to at one point over $102. This is a great acquisition for the company and is primarily one of the reasons we still feel that it has, although not levels of growth we highlighted in mid-2019, still pretty significant growth moving forward. This is a company that has somewhat struggled to grow its top line over the last 5 years. I mean, we can see that revenue in 2017 of $4.9 billion is essentially flat with revenue of 2020, but I really do feel that if the COVID-19 pandemic hadn't hit, this number would be a little bit higher. And I do expect with the new acquisitions and the newly acquired assets that this is going to be a top line that is going to grow faster. And if we do look at net income, this is a company that has been growing its bottom line pretty significantly over the last 3 years. We can see that net income has gone from $162 million to $369 million, and we can see that EBITDA has essentially doubled over that time period, going from $458 million to $950 million. This is a company that has provided significant gains to people who purchased it, believing in it back in 2019, and I expect them to provide decent growth moving forward. This is an excellent trucking and logistics company, a company that is really going to operate under any economic circumstances, and it's one that I plan to hold for a very long time. Now let's move on to our third and final stock. That is an alternative lender here that has soared in price, and that is GoEasy Limited. They trade under the ticker GSY.TO. So probably one of the biggest regrets of my investing career was not purchasing GoEasy Limited when we recommended it to premium members back in 2019. We highlighted the stock in the $32 range, and if we look to its chart, This is a alternative lender here in Canada that has performed insanely well. $10,000 invested in goeasy Limited 10 years ago is $131,000 right now. And keep in mind, this does not include dividends. This is one of the best dividend growth stocks in the country. And if we look to its 10-year returns, dividends included, that jumps up to, if you had invested $10,000 10 years ago, you would have $174,000 today. And I mean, even if we scale this out to the short term, if you were to invest $10,000 even 3 years ago today with dividends, you're sitting at around $34,620. So this is a stock that has essentially been one of the best performing stocks to Canadians, to investors anywhere that bought it, and the stock continues to grow even today. Now, the one thing I do have to reiterate before I speak on what goeasy does is there is some investors who do not invest in companies like goeasy because of their what they view as predatory business model. And this is completely appropriate. If you don't like what a company does, it does not make sense to invest in them, no matter how much gains you receive. I mean, if you don't like investing in tobacco companies, if you don't like investing in alternative lenders, if you don't like investing in alcohol or wine companies, that is completely appropriate. You have to understand that this is a specific niche in Canada that does tailor to lower credit quality borrowers, and as a result, the company does charge some pretty high interest rates. So what exactly does goeasy do? Well, they are a small cap Canadian stock that provides non-prime leasing and lending services through its Easy Home and Easy Financial divisions. The company has issued over $4.5 billion in loans since its inception. And the thing about goeasy is it literally, you can buy pretty much anything through them. If you want a new couch, if you want a just one-time loan, if you want a new PlayStation, they will give it to you on a payment plan and you pay them to own the product. Now, the one big misconception that a lot of people get with a company like goeasy is the fact that it caters to higher risk lenders, so they are at bigger risk of defaulting. And while that's true to a certain case, the one thing that is important to note about goeasy is the vast majority of its lenders do not hold a mortgage. They are essentially renters. And as you know, the mortgage is essentially going to be the first thing you're going to pay, and it is also typically the highest bill you have. So if you are mortgage free, that essentially reduces your debt load more than somebody who has a mortgage. So I really think something that is overstated with goeasy would be the quality of their customers. It's not as bad as you think. And the company has actually reported that over 60% of its customers have reported a improved credit score after dealing with a goeasy loan. So for a lot of customers who are essentially cast away from the banks because they don't make enough or they are a higher credit risk, they go to goeasy, they prove that they can make these payments, and they improve their credit score. So if we look at the financials of goeasy, we can see that operating revenue has increased drastically. I mean, if we look back to the 10-year period, back in 2011, revenues of $174 million, that has scaled up to just under $653 million in 2020. And if we look at the bottom line of the company, the most important thing, we can see that net income has soared over the last decade. Net income of $9.6 million back in 2011 is now $136 million in 2020. And if we go to EBITDA, it gets even better, as the company has essentially nearly tripled EBITDA since 2015. So this is why this company has been able to grow its dividend so drastically. Now, a lot of people say that the easy money has been made in goeasy, and I would argue that that is true. I mean, we highlighted the stock back in the low $30 range. It's now sitting at just under $125 a share. You're probably not going to see this exponential growth from the company moving forward just over a couple year span. But that should not deter investors from at least having a look at goeasy. I mean, if we look at its most recent quarterly report, the company reported its 43rd consecutive quarter of same-store sales growth, 78th consecutive quarter of positive net income. They had record revenue of $137 million, which is up 5%. And most importantly, this was a company that hiked its dividend by 47% in a single quarter. goeasy doesn't have to abide by the OFSI's conditions to not raise dividends, whereas the big banks and major insurance institutions have to. So it was able to raise its dividend, and it raised its dividend at an insane clip, and it has been doing so for a long time. Overall, I really think that this is going to be a lender that more and more Canadians are flocking to. There is a huge rise in alternative lenders here in Canada, and people are opting out of the big banks and heading to companies like goeasy. A lot of people view their business as predatory. I view it as somewhat them helping Canadians get back on track. But that is completely up to you. You have to decide whether you are able to invest in this company or not. But I still see strong growth in the future for goeasy. But that's it for the video, everybody. There you have it. 3 great stocks. 3 stocks that we highlighted over at Premium that allowed members and Matt and I to take huge advantage of, grow our portfolio significantly. Again, we've got a ton of stocks that we expect to outperform the market over at Stock Trades Premium. So if you are interested in joining, head down below to the description, sign up for free. We'll give you 3 picks absolutely free. And if you want to upgrade to the full platform, it will give you a huge discount once you sign up. But again, stay tuned to the channel for more great Canadian content. Until next time.